Lots of banks had plenty of buybacks, but the banks did lose some early gains today after strong results following those Fed stress tests. Leslie Picker has had a look at whether the Fed should be looking beyond the banks when deciding what's included in those tests. Leslie.
Hey, Wolf, that's right. Specifically, non-banks. These are asset managers like BlackRock and Vanguard, which manage a combined $11 trillion and are projected to double that amount over the next decade. That's largely thanks to the growth in passive investing in the form of exchange-traded products and index funds. Global regulators have already sounded the alarm on issues like liquidity mismatch and leverage, but so far we really haven't seen much in the way of stress tests here in the U.S. Mohammed Al-Arian said on Squawk Box today that regulators aren't focusing enough on these non-banks.
So people enter an ETF because an ETF promises you instantaneous liquidity at reasonable bid-offer spreads. There's a major shock to the market, and they find that they cannot get that liquidity. What do? They sell something else. That's what people do. I've seen it over and over again. As they sell something else, you start getting financial contagion. As financial contagion spread, you get the risk of economic contagion.
So you saw glimmers of this in February where a short volatility-linked exchange-traded note called XIV blew up. That one security caused investors to lose about $2 billion. But the concern is whether something similar could happen on a much larger scale, guys.
I mean, I have to say I slightly disagree with this sentiment that Mohammed was talking about there, because it's very different where you keep your cash that's meant to be safe. And you know, if a bank does something too risky in the other part of its business and it draws down people's safe savings is one thing. But if we're investing in the stock market, we should know that there's risk attached to it. I don't know if it's the same kind of debate.
Well, there's risk attached to it when investing in the stock market, but I think what he's referring to with these ETFs and ETNs is kind of the more interconnectivity that those assets have with the broader market as a whole and the contagion risks associated there. Also, a lot of, regular investors will put their money into mutual funds and expect that to be safe and diversified, kind of in the same way that they would put their money in the banks without that FDIC insurance, of course. But how do all of these things link up with the banks, I think was his point, more on that contagion side of the equation.
Well, Mike, we saw how higher AUM in ETFs and so on has led to a bigger sudden sell-off, more volatility when you get one like we saw earlier this year in February. But again, that's for investors to know about, is it not?
It is. I mean, I see it as a subject for the Fed to look at for general systemic risk areas, right? But in terms of studying the individual institutions, for example, a BlackRock or a Vanguard that are very big in these areas, what are you actually going to be measuring? There's no capital they have to hold against it. Is it just a matter of saying, can some instruments be too unwieldy for the market to handle in a stress situation?
What do you think, Sandy?
Yeah, I like that we've scaled back Dodd-Frank stress tests and that sort of thing. I mean, you look at the 35 banks that went through it and, 1.2 trillion in capital, and I think that they came through okay. But I'm a big fan of capital markets and putting the burden, which is what Congress really wanted to do, put the burden back on the banks rather than having the government really handle it. So I'm a fan of deregulation.
A lot of it is also for PR, right? I mean, if the banks were to blame for the last crisis, making the stress test public was a big effort from the Fed to show we're on top of this and the system is healthy and they're not going to bring us down again, right?
Exactly. And I think, every financial crisis that pops up is different each time. So if you plug the holes from the last financial crisis, inevitably another crisis, recession, that's just kind of the way the cycle works, will come from somewhere else. And so I think a lot of people are looking now to see where that potential risk could come from and how that could then spread into the banks, which could cause more contagion later
After the 1987 stock market crash, there was a rule that every brokerage firm had to report the volume of program trading that they handled every week, and it was meaningless for decades after it happened.
Always chasing the last blow up.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.